And joining me for a closer look at the day's market action is Anthea Gardner from Cartesian Capital. Anthea, thanks so much for joining us in studio this afternoon. Now, markets have somewhat shifted their focus. At the beginning of the week, we saw, everything around Trump's tariffs and that moving markets action. Now we are seeing, that sell-off slowing down. We're seeing a market recovery coming through, and focus is now shifting to that US jobs number. We know that December numbers were really, really strong, blockbuster numbers. Do you expect that kind of number to come through in January?
So the consensus for today's non-farms is 175. We saw some decent numbers yesterday, and I think it's going to be a case of good news is good news, and the market will take what it gets. I don't think there's going to be much divergence. Last month, the number was massive, and so 220, and so it was, it was good for the markets. The focus today, obviously, on this number is almost combined with where we think interest rates are going, because now you know that Trump is in office and he's putting pressure on the Reserve Bank, the Federal Reserve, and I think they're going to stay and be independent, and Powell probably knows his job is in contention at the moment, but the market wants to know for sure where this is going, and that's going to be the trick today.
Will it be much of a market mover, considering that we already know that the Fed is really on a pause cycle, and that we'll probably only see rate cuts coming through perhaps in the second half of the year?
Right, so we're expecting a rate cut in June, nothing before that. But again, we've got 4.5 months to go before June, and anything can change. And with Trump's rhetoric around tariffs, which is interesting because everyone thinks that tariffs are going to be inflationary. When he was last in office and he implemented tariffs on China in 2018, nothing happened to the inflation rate. In fact, it went down a little bit, and it only spiked sort of during COVID and when we had quantitative easing, and people were trying, central banks or governments were trying to restart the economy after COVID. That's when inflation really kicked up. So we'll see what happens. I think, Trump is definitely emboldened this time around. There's no doubt about it. He's more likely to implement something this time around because he's got really nothing to lose. But I also think that his advisors will keep him in check to a point. I think the advisors are acutely aware that if China wanted to, with their $1 trillion trade surplus and the US's $1 trillion trade deficit, that they've got the upper hand. And if they started selling off treasuries, for example, or let go of the US dollar, it could send the US into recession. So I think Trump's advisors are acutely aware of that. So he's being a bit of a bully, like a sandbox bully, isn't he? He's picking on the small countries like us and Mexico and Colombia and Greenland. I mean, the list is endless. So I think it really is going to be a wait and see how this plays out. For now, and because we don't know, markets are volatile. So every time he says a word, something happens.
You'd expect it to be priced in, Anthea, considering that we've been knowing that Trump will be coming into power, and we sort of knew that these tariffs would come through, just not maybe how big the tariffs would be.
Yeah, but he has rolled over, right? So he's threatened and then rolled over and said, okay, well, I'll hold it off for a month and let's see what happens, and I won't do this just yet. And it's all just rhetoric at the moment. And so that's the problem. It's not priced in because the market doesn't know how this man is going to react. He can talk all he wants to, but is he going to follow through? We don't know.
What we do know is he's big on AI, and Amazon out with results last night, overnight. Those numbers quite mixed because retail revenue was up, but the cloud sales were disappointing. Just walk me through what you made of that report.
Yeah, so the share's down today. I thought they were an okay set of results. Not fabulous, not terrible. But I think the problem there is their outlook is not great. And that's the first problem. And then the second problem is the money has now shifted from American tech to Chinese tech. So since we've seen DeepSeek and the likes, the market participants are now have kind of shifted their gaze from the US tech, the Magnificent Seven, into Chinese tech and going, oh, so where's the next great tech going to come from? And I think it's been difficult. Like AI hasn't delivered revenue the way perhaps we would like to have seen it. You know, these US tech stocks are trading at incredible multiples. And it feels like 2001 all over when everyone was sitting there going, can I actually buy a stock that's trading at over 100 multiple? Like, is that even feasible? And then you see competition from the East and you're like, oh, but maybe I don't have to pay that sort of multiple. I can go and find value somewhere else in a different region in the same sector. And I think that's what's happened to poor Amazon, even though it was
caught up in more of a trend that's been playing out.
Yeah.
Would you then say, considering what's been happening in China and the emergence of DeepSeek, that the AI investment, the AI spend we've been seeing from US tech stocks is warranted?
I almost thought they haven't spent enough.
I
think, yeah, so yes, they've spent a lot, but I think the market is saying, well, you guys haven't done your homework, you haven't done your research. Look at the Chinese tech stocks, look at DeepSeek. They're delivering for cheaper what the US is spending loads on. So maybe they should have spent a bit more to get it down. You know, this theory, is it Moore's Law or something? I forget which one it is, where the tech should have been cheaper, but they haven't done their research properly. They've kind of depended on being leaders in the field, front runners, which doesn't always work out, right? There are such things as lost leaders.
Let's keep that theme around China, and I want to talk to you about the Chinese consumer, right? So we've seen tons of companies, luxury companies, beauty companies, recently L'Oreal, just pointing to the weakness of the Chinese economy and the Chinese consumer. I mean, you'd think that there's potentially a recovery coming through, looking at those GDP numbers that were out for Q4 and 2024.
Yeah, Taoleng, I think we need to distinguish between the consumer and GDP growth. So I'm a huge China bull. And last year I kind of walked around going, China gets what China wants. You know, if they want Chinese 5% self-imposed growth, GDP growth, then they will make sure they get it. The problem is the Western skepticism, right? So if that 5% doesn't come through in our timeline, the way we expect it, the way we as Westerners see the world, then we go off and sell the market and we panic, right? So they had 4.8 and 4.6% GDP growth for the quarters, threw a whole lot of stimulus into the economy. They did try to re-stimulate kind of the consumer spending. It hasn't really worked. But China knows that their strength is manufacturing. And they've got a 100-year plan. They don't care that we report quarterly and how we see the world. You know, they're on a much longer trajectory, and they're going to lead the world. They opened up the world's largest solar farm in June of last year. It kind of went unnoticed. You know, they don't have one Silicon Valley. They have 9 Silicon Valleys. And so just because we kind of think that the economy like ours is 60% dependent on consumer spending, that's where the focus has to be. I don't think so. Right. I mean, so we saw L'Oreal come out with results last night, was it? Last night. Also not a bad number, I thought. So quarter sales were 2.5% up for the year, 5%. Market didn't really love it. But because, again, guidance not looking good, and because they said it wasn't as good as they would have wanted it, because the Chinese consumer didn't buy makeup, right? Luxury goods.
They've been saving up, they've been tightening their purse strings.
Right, exactly. But when it comes to market... We just have to leave the conversation there for a bit. Before we get to your stock pick, though, let's just reflect on some counters that have found favor with your industry peers.
I'm going with Clicks. It's one of those that it's never cheap enough, but it's had a decent pullback from its highs. It's going to capture sort of this. It's got the stability of the core healthcare piece and the pharmacy piece. Plus, you've got the front shop, you've got the beauty. That's going to capture the sort of improving environment I think we're going to see for South Africans. Rate cuts feeding through and a better macro outlook. So I think you're getting the best of both worlds there. I think they've got a good growth runway, decent capex rollout plans, store rollout plans, etc. Excellent management, excellent execution remains in place. So that's my call, is to buy Clicks.
That's the global silver miners ETF. I think silver has lagged gold badly. It looks like it wants to break out from $33 an ounce. If it does, 50 might be on the cards. And then, the silver miners have been underperforming themselves. So I think that one can pop quite nicely. So it's, that's mine.
So a bet on silver miners as well as clicks. What have you made of that analysis?
I absolutely can't disagree with Grant. He's right. You know, it's a volatile environment. We want something stable. He's not wrong. This thing is expensive.
Very.
But it's a perfectly priced and always has been. I'm not sure I agree with Drickers. I get it that technically this thing looks like it needs a bounce. What's going to be the catalyst, though? That's what I'm not sure about.
All right. So I know your pick is not a stock. Take us through what you are picking for today.
So we understand we're in a volatile environment, and we've realized that where interest rates are at the moment and where our inflation rate is, if you bought money market funds, for example, money market instruments, you're getting a real yield of 5.5% for very low risk. So we're going with that. We want real yields at 5.5% with very little risk in the money market instruments.
Anthea, thanks so much for joining us today. That was Anthea Gardner from Cartesian Capital.